What can we expect for the last 2 hours of trading?
We brought together the Fox panel, brains and beauty, of course, to talk about it, starting with independent trader Eric Bolling. What a face. What a put him. Mike Norman, founder of Economic Contrarian Update. Nicole Ridgway from smartmoney.com. Jim Pettakakis, assistant managing editor from U.S. News and World Report. And Peter Schiff of Euro Pacific Capital. And let's start with you, Eric, because you're the oil trader. You're watching this decide whether to hit 100, and then you see the markets finally really kind of reacting in a negative way.
Yeah, I was down there for the whole release, the pre-release. Last night, oil traded $98.5, almost $99 a barrel. People were waiting for a bullish inventory number. They got it surprised. They got the surprise for the first time in 4 weeks. The surprise was to the bearish side, and you saw some scrambling out of position. And Liz, I got to tell you something. I've seen this before. We have an option expiration next week. Keep your eyes open.
Tell us what that
could
means.
be. Okay, that's once a month. These contracts expire, so people holding contracts have to get out. Typically, you see higher. You see sometimes 50% higher volatility on these days. What I really think is going to happen is if we start to find a home in this mid-$90 barrel oil price, you're going to see that push towards $100 barrel on that option expiration.
Mike?
Well, if we're talking about oil, here's what I don't understand, and I'm going to ask you the question, all right? Since 2002, we've seen global consumption rise 6 million barrels a day, but we've seen production rise 7 million barrels a day. The price has gone from 10, 15 a barrel to 100. Global stocks of oil right now near an all-time record high, about 4.2 billion barrels. I just can't figure it out. Why do we go from $10 to 100 when production is meeting consumption right now? It's speculation.
Can I throw this out here? It's not speculation. It's a situation where we've peaked at production. Production is actually declining year over year versus... No. You gave me from 2002. I'm telling you from 2006. Our production, the world has peaked out. Unless we find new areas to drill in, we're going to start to decrease the amount of oil we pull out of the ground.
So, Peter Schiff, why today? Why do the markets fall more than 200 points today when oil's been moving all over the place and the markets haven't moved in lockstep?
Well, maybe they finally reacted to some of the comments overnight coming out of China about moving out of the dollar. But, the problem is the world has been printing a lot more money than we've been producing oil. That's what's been going on. This is all inflation. You have central banks around the world creating too much money. Even the euro. We talk about the strong euro, but the euro is weak, too. It's just not as weak as the dollar.
So, Peter,
look at the price of gold. It's rising against all currencies. And the price of oil has remained constant in terms of gold.
So, Peter, what happens?
The price is not rising.
What happens to the markets within the next hour and 2 hours?
Well, I don't know what's going to happen in the next hour, but, the markets are going down. The Dow is down big today, but if you price it in other currencies, it's losing twice as much value. Yesterday, you guys were talking about the fact that the dollar was weak, but it was not affecting U.S. stocks. The weak dollar always affects U.S. stocks because the Dow, when you say the Dow was 11,500, it's not 11,500 bananas, it's $11,500. And whenever the dollar loses value, our stocks lose value.
Okay. Nicole, let me just ask you, though. The folks out there looking at the market, it's now down 243. The Dow Jones is down, NASDAQ as well. Yesterday, they saw the market up. What are they to think? What's driving this market? Because the news on oil was out yesterday as well.
Well, I think that the financials are definitely impacting the market today. There's no doubt about it.
But they were impacting it yesterday, and the market was up triple digits.
Yes, it's been a very confusing run for the last few weeks. We're getting a lot of conflicting different reports, and it's hard to make sense of it all. And everyone's worried about the holiday retail season and all these pressures on consumers. They're worried that oil is going to affect consumer spending, and they're worried about the subprime mess being extended even further.
That's the thing. We haven't seen it. And as long as we haven't seen the impact on consumers, we saw an uptick in the third quarter for consumption. We see exports growing and contributing to the economy in a way that we have never seen before.
And so, if
the economy is handling the higher oil price,
that's right.
We can look at it and not get that disturbed about it. Liz, to your question, what's going to happen to the market? Look, it seems like...
Wait, hold on. You ask your own questions and then come out with your own answers. We haven't given Jim Pettakakis a chance. Go ahead, Jim.
Now, look. So maybe the difference today versus yesterday is that right now people are looking at what the economy did in the third quarter, which was 3.9%. Now a lot of economists think the economy may have been growing at 5% in the third quarter. That makes it far less likely the Fed's going to cut rates. But then they keep cutting rates when the economy is growing at a 5% pace. I think would really send traders scrambling because it looks like it's inflationary. And right now, I think the market is very worried that the Fed is behind the curve with the financial crisis, and if they're not going to cut rates, they're worried they're going to get further behind the curve, and where the financial crisis could expand and get a lot worse. So I think that's one thing, in addition to oil, in addition to the dollar, which is weighing on the market.
I love, Eric, these worries. Each day, it's almost as if people and investors wake up and say, what should I worry about today? And it's always the same things that were in place the day before.
Well, there's something new today. We haven't touched on it yet. In GM, the GM news, they reported a loss that was 10 times what people expected. And that really caught a lot of people by surprise. GM, we all thought GM was on a recovery pace, and then they throw this at us. I haven't. You stay away from autos. Autos, if you look at in Barron's every week, you see market indicators, and it shows you how many autos are sold domestically, how many autos are sold domestically from imports, and those are, we're losing 8%.
GM is doing really
imports
well.
Imports are increasing 8%.
They're the biggest automaker
They're not
in China.
doing that well if they report a $32 billion loss.
What are they off? A couple of percent. They're the biggest auto manufacturer in China. Is going to be the biggest market. I happen to own GM stock. I bought it in the high 20s. Okay, it went to 42. It pulled back, but I'm going to hang on to it.
Peter Schiff?
Well, to say that the economy is not being damaged by these high oil prices, part of our trade deficit, one of the reasons it's so large is because oil is so expensive.
Yeah, but
so
Peter,
we're borrowing this money. The nation is going deep into debt right now, so we can pay for this oil.
The trade deficit has been shrinking. If you look at the past few quarters, we've actually had a reduction in the trade deficit and a broader measure, the current account deficit. It's turned around, and it's turned around even with record high oil prices and a lower dollar.
Jim Petticoat, go ahead, Jim.
Look, we've had this slow motion crash in the dollar month after month, year after year, and all the economy has done is continued to boom. November's the 6th year anniversary of this boom.
Gang, we're going to have to take a short break. We'll be right back. We're keeping our eyes on the market for you.
Stay tuned. Much more ahead.
So does a weak dollar really matter? Our Fox panel is back to talk about it. Eric, I just got a note from a guy who was a currency trader. He was one of the biggest there is. He says, I would not be short the dollar at this historic level. That is, he wouldn't bet against the dollar now. All the short sellers are in already. You agree?
No, I think this is not a buying opportunity. It might even be a selling opportunity. I mean, I go out to dinner on Saturday night. The couple next to me is from Canada. They said they brought empty suitcases over here because they're going to load up because America's on sale. That's not a bad thing. That's a good thing. What they do is these strong euros, these strong Canadian dollars, these strong British pounds, they come over here, they buy U.S. goods. They deplete our inventories. They spend money in our stores. Our factories run. This is why Mike referenced the trade deficit. It's shrinking. It's shrinking because of that, because our dollar is weaker.
Wait a minute, you guys are actually agreeing on something?
You don't know, we became good buddies now. No more. We're gonna be good friends. Listen, look. When I see supermodels shorten the dollar, I think it's pretty much over, okay? The only thing we got to see now is Britney Spears taking out a foreign exchange account and going short. Then it's going to be really time to go long the dollar. But look, I don't agree with what former Treasury Secretary O'Neill said. When you get into this jingoistic, the currency is a reflection of the health of the economy, that's nonsense. Look, Asian nations for decades have kept their currencies down just in order to promote exports and to stimulate their economies. There's no connection with that whatsoever.
I know somebody who's going to really throw some water on this fire. Peter Schiff. Peter.
Yeah, as somebody who's been getting out of the dollar successfully for 8 years, I can assure you it's a long way down, and this is not a good thing. Sure, it's a good thing for my clients' portfolios. It's not a good thing for them as Americans, and it's not a good thing for any American. These Canadians.
No, one reason why.
Because when the dollar is losing value. When the dollar is losing value, Americans are getting poorer. The value of their wages is going down. When you're talking about these Canadians who are coming in and buying things, they're buying things that Americans can now not afford. As the dollar loses value, things get more expensive for Americans. They get cheaper for everybody else. And, when the dollar is really going to start to decline is when the Chinese finally allow their currency to rise. The dollar is weakening because the Fed is creating inflation. When they create money, they diminish its value. And when the dollar loses value, prices rise.
Nicole,
prices for things like oil that are globally traded rise immediately.
Okay, but
there's
hold on
for
a second,
domestic
Peter. Let me
prices,
give
but it's
somebody else a
coming.
chance to get in here. Nicole, there is good news on inflation today. Productivity has increased beyond expectations. That is, people make a lot of things quicker and cheaper than they used to. That keeps inflation low. So that might mean that, in fact, the Fed is on the right track, no?
Yes, I mean, yeah, because now employers, they're making more products, so they're selling more, and they can keep the prices lower.
Peter was against the Fed lowering rates because he said it would be inflation, but there are signs that inflation is in check.
Yeah, that was definitely a sign that inflation is in check, I believe.
Excuse me, productivity is way up, Peter. That's what I was talking about. Go ahead, finish your point, Nicole.
It's not way
Hold on, Peter.
It's not
finish
way
your
up
point, Nicole.
It is a sign that inflation is in check, and it's a very positive sign. And as far as the weak dollar goes, a lot of the for the U.S. consumer buying imports, they might see a rise in cost that way, but a lot of producers are going to try to absorb that extra cost so that it's still affordable to the U.S. consumer.
Can I just sum this up? The dollar going down is not a precursor to our economy. What it says is growth outside the U.S. is stronger than growth in the U.S. Growth in the U.S. So we're still growing. It's just that China's growing faster, India's growing faster. Some of the other countries whose currencies are appreciating faster are growing faster.
There's no connection. You know, Peter talks about the dollar at an all-time low against the euro. Inflation, which is implied, let's say, in a Treasury inflation-protected security, a TIP, it's about under 2% right now. So the dollar has gone down since 2002, this whole period, 8 years that he's been getting out. Where's the inflation implied? Wouldn't you think that Treasury holders would want to get a higher rate of return? It's not in there.
Go ahead, Peter.
Mike, all the good news on inflation is coming from the government in these numbers. All the real-world examples of inflation, like the price of gold, the price of oil, the price of food, the price of agricultural commodities, the money supply growth, there is massive inflation here, and if you guys don't want to recognize it, you're going to do so at your own financial peril.
Mike,
the reason we're making so much money.
Hold on, guys. Deflation and
Mike,
a lot of things.
Everything is more expensive here. I don't care if it's a certain Leapster toy that I was buying my kid last year. Now it's more expensive this year. Milk.
But
everything's more expensive.
Well, we can go back to 1920 when it cost a nickel to go to the movie theater. I mean, you're making more money now, too. Inflation adjusted earnings now are the highest they've been in 27 years. So, I mean, everything goes up.
Isn't this the guy who's just telling me that oil was $10 a barrel a few years ago?
You could have bought a brand new car in 1965 for $3,500, a Mustang. Now it costs $20,000. Is that to say it's inflation?
No, but all I'm saying is that when the government comes out with numbers, we're hearing from people who are middle class saying, I'm just spending a lot more money on this stuff, and my salary hasn't gotten better.
The thing is, the wage growth is also strong, so more people are employed, they're making more money, they're able to spend. Good news is, they're able to spend.
I have to disagree one point. There was another statistic out. I know, Peter, you hate statistics from the government, but you'll like this one. Labor costs have fallen. Now, that's good news on inflation, but it's bad news for the people making money, right? Peter?
Well, look, I don't think there's any good news on inflation. There's a reason why we're making so much money in inflation hedges. It's because there's inflation. The reason the euro and the Australian dollar and the Canadian dollar are going up so much, the reason commodities, gold and oil are going up is because there's inflation. This isn't a coincidence. This hasn't happened since the 1970s.
Okay, we're going to check the markets very quickly for you as we get closer to the closing bell.
Much. Well, Fox Business Alert, oil is taking a break today at its run to 100, closing a bit lower.
It's still close, though. Stocks are a lot lower, though, as we begin the final hour of trading. Dow is down 232 points, and the question is, could expensive energy and then a falling stock market coupled together be the Grinch that steals Christmas if those factors curb consumer spending?
With us now, Mike Norman, founder of Economic Contrarian Update, oil trader Eric Bolling, Nicole Ridway from smartmoney.com, and Jim Pettakakis, who's assistant managing editor from U.S. News and World Report, and Peter Schiff, who is of Euro Pacific Capital and author of the book Crash Proof. Let me go to Jim first. Jim, on oil, how much of an effect does that have on the market? Because after all, we saw oil go up yesterday and market was up. We saw oil go down today just a tick, but the stock market is way down.
Well, I mean, I think in the short term, and as you just said, it's tough to say what the market and oil are going, how they're going to react on any given day. But I think really over the longer term, the effect of oil on consumers has been vastly overrated. We really saw the equivalent of $100 a barrel oil really last summer on consumers. We had all these refinery problems which shot up gas prices to really the equivalent of $100 a barrel. And guess what? The consumer kept spending. Really, the hidden story of this economic boom has been the growth in wages and incomes over the past 3 years, and that's really helping offset a lot of these price rises we're seeing in oil.
You should see Eric Bolling's face. He's like this, Jim. He's going,
not mad at me for once.
You know what it is? It's just we've had a $30 move up in oil, and we haven't had that gasoline price. But this is the right price. Last year, when we saw that big increase in gasoline prices, it was way too high. Refiners were making too much money. They were gouging us. We were putting money into their coffers. You got to look at the refiner charts. They're off the top of the chart, making so much money, and now it's correcting. I've traded for 22 years. Gasoline profit margins, I don't want to get too complicated, the money that they're supposed to be making is about in line right now. $5 or $6 a barrel right now is right. It's what it's been for a long time. It spiked to $35 post-Katrina, but now it's back in line. So this is okay. I beg to differ in that. I think these are more normal prices.
No, my point here is that a lot of people they see the big round number, $100 a barrel, like that's going to push us into a recession. I mean, that's just not going to happen. This economy is far more resilient to high oil prices than it was back in 1980. Plus, you have all that money which is flowing out of the country to OPEC. That money also flows back into the country in the form, and they're buying bonds, stocks, lower interest rates, higher stock prices over the long term. And any given day, of course, the market can go down.
Mike.
Very good point that Jim just made. There's somewhat of a circular flow. In addition, let me just say this. The United States is the third largest oil-producing nation on Earth. 7.5 million barrels a day. We have a huge oil industry here. So while, up here in the Northeast, we feel it, folks down in the Gulf states, in Texas, out west, there's a boom going on out there. So that's another sort of a circular flow back into the economy, high levels of investment. What are you looking at me? I'm just looking at What are you looking at me like that for?
He might have been agreeing with you.
You should have seen they were like,
my head off.
He might have been agreeing with you.
Agreeing with me for once?
So far, keep going. Let's see.
I'm done now.
I know who's going to disagree on some level. Peter Schiff. So, Peter, what do you think? I mean, if $100 oil is or is not going to put us into recession, and I know you're going to say, we're already in recession. Not yet.
Yeah. When it comes to consumer spending and Christmas time, consumer spending, excess consumer spending is how we got in this mess in the first place. Borrowing to consume is not economic growth, it's economic suicide. I warned last week on this program of the ticking time bomb in credit card debt, that this was the next subprime. And you just reported on that earlier. And, I think this is coming. I don't know if it's going to hit us by this Christmas, but certainly by next Christmas, Americans are not going to be able to charge Canada's credit cards. Limits are going to come down. Credit is going to really tighten up, and Americans are going to finally stop spending.
And you'll officially be the Grinch who stole Christmas, because we will have forecast the whole thing. Listen, there has been no pullback in consumer spending. I want to go back to this point of wages now rising at the fastest pace in a very long time. And yes, look, let's be honest. Nobody likes to go and fill up with gas and pay $3 a gallon, $3 plus. It hurts. It certainly hurts middle income and lower income people. But it has not had the devastating impact on the economy that many would have predicted, several years ago. Look, we're at $100. We went from 10 to 100. We're just 4% off on the Dow. Yeah. The economy's posting 4% annual growth rates. It's pretty darn good.
By the way, Jim, we should mention today, Jim, Walmart was doing pretty well. It was one of the few stocks that was up. We have our friend Toby Smith saying that, in fact, his experts, and he's put together a group of people that track these things year after year after year, say that consumer spending is not going to be hit by Christmas. What do you say?
Oh, I don't think so. Really, the untold story here is that both wage growth and income growth since 2004 have been extremely strong. You look at Walmart, the company that's supposed to get hit by higher gasoline prices because it's supposed to hit their, their demographic more. We just talked about that. And look at, you want to look at stocks? Look at Google. Look at Google. That's sort of my new market bellwether. If we're really going into the tank, there's no way Google would be almost flat today, given their PE ratio. They have their hands in so many parts of the economy. Advertising, all that. There's no way they would be flat, I think, if people are that worried about us going into a recession.
You're talking about all this extra income. We're earning more dollars, but the dollars we're earning have less purchasing power. Measure our income in Canadian dollars. Measure our income in Australian dollars.
I'm not buying Canadian products right now. All right, I'm not buying.
Exactly.
No, but ultimately,
listen. What's been keeping this market?
Our standard of living is determined by the value of our currency. Our prices are ultimately set by the value of our currency.
Hold on,
yes,
Peter.
they
Hold
are.
on, Peter. Hold on. Go ahead, Jim.
Listen. The wealth of this country has gone up by $20 trillion over the past 5 years. And you know what? Even with the decline in the housing market, we're still up immensely. Wages up. Income up, market up.
Okay.
That's what's been keeping this. That's what's been keeping this economy growing.
We only have a trade deficit 5% of our GDP. That means
it's going down.
We produce 95% of what we consume. We only take in 5% from the outside world. So our standard of living is not going down.
Okay, zip it, everybody. Shh.
Yes, it is.
David.
Listen,
We are still keeping an eye on the markets.
Joining us is Onkar Ghate, a senior fellow of the Ayn Rand Institute. Onkar, since you're brand new joining us here, we'd love to hear your perspective on this pay-go issue. Okay, get rid of it. Get rid of the AMT, but that's $50 billion that gets pulled out of the system. What's the best way of replacing it?
Well, I think when you look at the pay and go, there's two things Congress can do. They can either shift taxes onto someone else's shoulders, and that's what Rangel's talking about, putting taxes on the rich instead of the middle class. Or they could cut spending. That's another way to have it revenue neutral. Eliminate a tax and then cut government expenditures. And that's what I think they should be doing rather than trying to now, instead of slamming the middle class, slamming the rich. I mean, one estimate was that 1.7 million of the highest income households would be paying an extra $70 billion in taxes. And I don't think that's just, and I also think that will hurt the economy when you start penalizing people for their economic success.
Well, Mike Norman, I got an idea. Since when they lowered tax rates, they got all this extra income that they weren't expecting. Maybe the best way to collect more income is to lower tax rates even further.
You could lower tax rates, or you could just do away with the AMT and stop trying to figure out how you're going to pay for doing away with it. Look, the $50 billion, Liz, is 0.3% of our GDP. We're running about a 1% deficit right now. Look, when are we going to finally learn that these deficits add stimulus to the economy? They eventually pay for themselves. When we ran a $400 billion deficit in 2003, we were seeing 9% nominal GDP growth. That's almost like China rates of growth. And now that has pretty much paid for itself. You got to do away with this AMT. It is a silly idea to say we're going to do away with it, but we're going to pay for it somehow because the net effect on the economy is zero.
Nicole?
Yes, I mean, if they don't pass any sort of fix, this is really going to hurt consumers and their wallets. An average of $2,000, and when you're making $100,000 a year, you don't have $2,000 probably handy just to pay extra on top of the taxes that you are paying. So, it's very detrimental if they cannot get a fix through. It's looking more and more likely that they won't be able to.
You know what I wonder? I wonder if this is one issue in which Peter Schiff would agree with everybody. Do you, Peter?
And actually, I don't. I mean,
shucks.
What a surprise!
The problem is our government is just simply spending too much money. We can't afford it. The government needs to cut back on spending. And if it did that, then we can reduce taxes. Maybe we can abolish the income tax entirely. If we can't do that, sure, I'm in favor of getting rid of the AMT, but not if it means raising taxes. Warren Buffett may be happy in paying 15%. But I'm paying 45%. I don't like paying 45%.
He's not happy. He says, it should be raised on the rich. That's his whole thing. And the rich certainly, many of them don't agree with that. Hold on. Look at the markets right now. We are increasing the losses once again, getting closer to the Sessions losses, down about, I'm talking, down 255
But Liz, I'm already paying 45%. How much more do I need to pay?
No, I agree.
45% of my income in taxes.
Listen, don't preach to the choir here. I mean, this is absolutely something that people care about. Omar?
Onkar,
I'm sorry.
Yeah, I mean, I agree completely. Our focus should be on getting the government to cut its spending. There's all kinds of programs that it shouldn't be involved in.
Yeah, but Onkar, who's going to start? We had on the Secretary of the Department of Commerce, and that's a department that I think we could both agree on could be eliminated without most Americans realizing it was eliminated. And even though he represented Republican administration, he said, "Don't cut me because what I'm doing is valuable." Everybody says that.
Well,
so what do you cut?
Then you could cut across the board. What happens if you cut 10% of every program? I mean, I think there are a number of ways you could cut government spending if you were really willing to do it. And one way would be just cut all these kinds of programs, take a chunk out of them.
Nicole, look at the markets right now. We're now down about 270 points. To what do you attribute something like this, where we got closer to about down 200 points and then started losing once again?
Yeah, I think it's just been this downward momentum for the last couple hours now, right? So, more or less.
Well, you know, we are in a bear market.
No, wait a minute. The definition of a bear market, Peter, we're not there yet.
Well, look, the Dow has dropped to
Peter's
62%. The Dow is down 62% in the last 8 years priced in gold. It's almost down 20% year to date. This is one of the biggest bear markets we've ever been in. You know, people are just deluded because they keep measuring their stocks in shrinking rulers called U.S. dollars. They're oblivious to what's actually happening.
Mike, you're deluded.
I guess I am then, but listen, I'm very happy to be deluded living in this country. My standard of living is rising. It is not falling. My household wealth is going up. Jim Petrakakis before told us 20 trillion over the last 5 years. And by the way, Peter, I just want to ask you, when you say the government is spending too much, put it in context. As a percent of our GDP,
guys,
it's the lowest level in 40 years.
We're coming up to a hard break as the market is down. Let me just talk about Washington Mutual for a second because it's down so much. Of all the times for the Attorney General of New York to sue or look to go after a company in the housing industry, this would not seem to be the time, but he's doing it and it's affected the stock.
Yeah, I mean, it's kick 'em when you're down kind of mentality here. But
and there are a whole bunch, by the way, of these class action lawsuits that are getting prepared for not only the housing stocks, but also those that have traded in these housing securities.
Yeah, this subprime ripple effect that's going on, I mean, it's going to continue much longer, and today was just sort of another indicator that it's just going to keep haunting us for a while.
And Peter, what's your thought on this?
Well, you know, it's no coincidence that the stocks that are the weakest are those stocks that are dependent on the domestic economy, that are exposed to the mortgage market and consumer credit. And those stocks that are holding up, at least nominally, are the ones that are tapping into the far more vibrant global economy. You know, there are hundreds of billions of dollars in yet to be fessed up to losses lurking in the balance sheets of these financials. We have just seen the beginning of these write-downs. There are huge losses. There are a lot of bankruptcies coming. I'm not sure which of the major brokerage firms or banks are going to go under, but there's going to be some high-profile bankruptcies, you know, even among the government, even Fannie Mae or Freddie Mac. I mean, we're going to see some problems there. They're going to be in need of a bailout. This is a real mess we got ourselves into.
Go ahead.
I'll tell you, I think right now I'm going to take my cue from Bill Miller, you know, the superstar fund manager over at Legg Mason. And you know what? He just said this week that he thinks right now what we're seeing is panic selling of a lot of these financial stocks. You've heard about price for perfection? Right now this whole sector is like discounted for damnation. I mean, you've seen the S&P 500 financial stocks lose about $500 billion in market cap.
Hey,
and basically they're discounting
Jim, we're coming up to a hard break. Mike Norman, we'll get to you in the next session of this. Stay tuned.
Put it to our Fox panel once again. Mike, you didn't get a chance to talk the last time.
Yeah, and I was going to say that Jim Petrakakis, he's a real smart guy. He's a smart guy. You said exactly what I was going to say. Look, I think this
about Bill Miller.
Bill Miller, one of the greatest investors, you know, contrarian investors, coming out this week saying, look, this thing is getting crazy to the point of being so oversold. The financials he's talking about, he's beaten the S&P 500 for 15 years running. He's having a rough 2 years here, but he'll come back. I think he's absolutely right.
Even though prosecutors and lawsuits are lining up against these companies?
But you said something, this pile-on, that was a terrible thing. And look, I have to say, I own Washington Mutual, and ouch is what I'm going to say today. It hurts a lot, but I'm a long-term investor. And I want to just mention something. You know, Peter's talking about gold. It's easy to pick periods in time. Peter, what about the people who invested in gold in 1980? They still haven't gotten their money back. Yet the Dow is at 700.
No.
Now it's at 14,000. Yeah. I can do this all day long. Stocks have outperformed, outperformed gold over the long term. In fact, stocks have been the best investment out there. And that's why I say to people, let me finish. That's why I say to people, stay long term. Stick with your investments in good quality companies. Hopefully that pay dividends and you'll be all right.
Peter, go ahead.
Let me answer this. Okay, you have to look at cycles. In 1929, the Dow was worth 20 ounces of gold. In 1932, it was worth 1 ounce of gold. In 1980, the Dow was worth 20 ounces. In 1966, the Dow was at 20 ounces of gold. And then in 1980, it was at 1 ounce of gold. Now it's at 16 ounces of gold. It's headed down. It was at 42 ounces of gold in 1980. This is a cyclical bear market in stocks and a bull market in gold. I didn't recommend that anybody buy gold in 1980. I didn't start recommending it until 1999. The people who bought gold in 1980 and lost a lot of money, that's the same thing that the people who bought stocks in 2000, 20 years later, they're still going to be down adjusted for inflation.
No, because
this is a bull market in gold, it's a bear market in stock.
Last summer, the people who bought stocks, if you were unlucky enough to put your money into the stock market in 2000, and if you had held on and reinvested your dividends, you would have went profitable by last May.
Eric?
I got a great idea.
Buy you would have been much better off buying gold.
Eric. Go ahead,
I say
Eric.
buy stocks and buy gold because they're both going up from here.
You think gold will go up further?
Oh, come on. Gold's on it can be a $1,500 ounce and still feel the same as it did in 1980. It's got a lot of room to do.
Nicole?
All right.
Yeah, I think gold still has a lot of room to run. And I also agree with Eric on the tech plays like Cisco, Microsoft. You know, it's not going to be high growth, but there's going to be steady growth.
Okay, so 300 points, though, David, right now to the downside for the Dow Jones Industrials. Fox 50's down, S&P, NASDAQ. Why? Can anybody give a single reason? Mike?
Psychology, panic. I mean, people are just, you know, this happens from time to time. Liz, we had the 1987 stock market crash, and it had no impact on the economy whatsoever. And by the way, with the subprime, we saw the S&L crisis wipe out, you know, an enormous amount. A similar situation where so many banks had to be liquidated, more as a percentage of GDP back then as what the subprime is expected to play out now. And it didn't affect
Jim Pettakakis, you know, that's not a bad thing to think about, is the S&L crisis, which at the time dominated the news. The headlines were about nothing else but S&L for about a year, and we got through it. Is it the same with the financials this time?
Well, you know, we're in the media, so a lot of us like to focus on, all the storm clouds.
That's right.
Forget about
the blood in the
sun behind
streets.
it. But you know what? Mike makes a great point. You know what? 2007 might be a lot like 1987, where you had this big market event, this big drop, and the economy just shook it off like Adrian Peterson shaking off defensive backs, for the Vikings, and it kept on moving. 1988 was a good year for the economy. I think 2008 we're going to see a reacceleration, have another good year for the economy.
By the way, just to put it in perspective, once again, we're about 2.5% down on the market today. That is a big number, that 318. But that event we were talking about back in 1987, well, that was 22% of the market.
22%. Yeah. So putting it into perspective is crucial. Go ahead, Jim.
Right. We like to just refer to that more obliquely as just an event. Okay. Not a crash.
Hold on, I think we're going to a break right now because we're getting very close to the closing bell. So stay tuned. We've got much more on Fox Business.